Okay, this lecture is on international monetary systems, and I put up a spectrum of international monetary systems, beginning on the left with the best, which is a market-supplied gold money, beginning with 100% gold standard, then going to a classical gold standard. The 100% gold standard in history was simply the system that arose naturally as a result of the development of money from barter. Okay, when money first developed, it was 100% commodity money. People exchanged gold, silver, copper, and so on. Now there's a split between the market supply commodity money, where you have a true commodity money at the base of the system. That is a money supplied by the market. And a government monopolized fiat money. Okay, and there's many varieties of government monopolized fiat money that we have seen in history. Okay. And one which hopefully we'll never see, but many new Keynesians are pushing for, a world central bank. This spectrum differs radically from the spectrum that you'll see in international trade textbooks. In international trade textbooks, if you've taken international trade or international finance, they'll have on one end fixed exchange rates and all the way on the other end fluctuating exchange rates. So what's interesting is that they would put a world central bank that issues one currency, where every country would be on a monetary standard just like the United States, just like every state in the United States is on a dollar standard and has absolutely fixed exchange rates. They would put that on the same side as a 100% gold standard. Okay? And over here you would have what the monetarists want. They want completely freely floating exchange rates, where each country has its own currency, fluctuating in value as determined by the market against one another, where the government does not interfere in the formation of the value of these different currencies on the foreign exchange markets. They would put that all the way on the other side. So this is a radical revision of the type of spectrum that you'll see. Okay, my criterion is how close is it to being a commodity money supplied solely by the market, okay, versus how close it is to being an absolute monopoly controlled by one monopolist. Whereas fixity versus fluctuation is the criterion used in current textbooks. Okay, I think this is the one that embodies Austrian monetary insights. That's the first thing I wanted to mention. Now, let me just start then with the classical gold standard. Okay, we've already, no doubt you've heard a number of times about the 100% gold standard, but let's talk about the classical gold standard, which operated fairly well in history. In fact, if you go back to when Great Britain went on back onto the gold standard in 1821 after the Napoleonic Wars, or when the U.S. went on to a sole gold standard in 1834, if you look at the level of prices, wholesale prices, you can even go back further to 1800. You look at the wholesale prices in terms of gold or silver, prices fall from the early 1800s very gently all the way down to about 1896 when we had gold discoveries in Alaska. And then prices rise again until about 1913. Okay? But they rise right up to what they were in 1800. So prices are no higher on the eve of the First World War than they were before the Napoleonic War, or actually in 1800 or so. As well as we can tell, remember, price indexes or price indices are arbitrary to a large extent, but they can give us an idea of gross fluctuations in the value of money. And so there is not much fluctuation. Money, whatever fluctuation there is, it certainly does not distort economic calculation by entrepreneurs, because we have a tremendous amount of capital accumulation during the 19th century. That is, entrepreneurs are able to correctly calculate the best uses of capital. And that's what all you can expect from money. And money cannot be perfectly stable in value. All right, let me say a few words first about the operation of the classical gold standard. Okay, the monetary system has lurched since the 1930s, actually since after World War I, from one type of government monopolized money to another type. But before 1914, pretty much, for the countries of the industrializing countries, you pretty much had a classical gold standard. What are some of the important characteristics? Well, very briefly, first of all, the so-called exchange rates are fixed, but they're not really fixed. Okay? They are fixed under classical gold standard in the same way that the relationship between a nickel and a quarter is fixed. Okay? A nickel, it takes 5 nickels to buy 1 quarter. The reason being, simply law of arithmetic. A nickel is defined as 1/20th of a dollar. A quarter is defined as 1/4 of a dollar. Okay? And so it was in the Western world during the 19th century. If we simply take the dollar, okay, the exchange rate between the dollar and the pound, let's say, 1 pound was defined as simply 1/4 of an ounce of gold. $1 was defined as approximately equal to 1/20th of an ounce of gold. And 1 French franc was defined as about 1/100th. So the exchange rate for over 100 years between the dollar and the pound was $4.86. Because there was about 5 times the amount of gold in a pound, British pound, as there was in a dollar. Okay? It only fluctuated within very, very narrow limits determined by the cost of transporting gold between Great Britain and the United States. Okay. So there wasn't really even fixed exchange rates. There was simply one money. Okay? Each national currency name was simply referred to a different weight of money. There was also a very important mechanism that operated to keep prices in terms of gold the same throughout the world. Okay? Just as prices throughout the United States are pretty much kept the same by the same mechanism. We call it the price specie flow mechanism. Specie refers to precious metals, gold and silver. Basically what happened was that whenever one country, now most countries, not the United States until not the United States at all, but most countries had central banks. Okay? But the central banks were constrained by what are called the golden handcuffs. Gold prevented or restrained the amount of inflation that could occur in the following way. For those that were in my seminar the other day, let me just put an inverted pyramid on the board. At the bottom was the amount of gold held by the central bank. Okay? And let's say that this gold in this hypothetical central bank was $2 billion. Now the central banks were able, under the classical gold standard, to create and issue paper money. Okay? Paper currency. So the Bank of England issued pound notes. But they were constrained by a legal reserve ratio, let's say 40%, which meant that they must hold 40% in terms of gold of the notes that they issue. So let's say they issue $5 billion of these central bank notes. So they have a 40% reserve. And then on top of that were the commercial banks. Okay, so we have they could issue bank notes and deposits, checking account deposits. But they had to hold a ratio, let's say 20%, in the form of central bank notes, CB notes. Okay? So for every dollar of bank notes or deposits that they issue, they had to have at least 20 cents in reserve in their vaults, okay, of the central bank notes. So let's assume then that this would mean that they could issue $25 billion. So in effect then, the money supply was $25 billion. Okay. The central bank notes could also circulate. I mean, you could use them also. So the money supply may have been a little bit bigger. But in any case, let's assume now that the central bank wants to inflate the money supply. Okay? That somehow it gets this ratio changed. And usually you control this ratio. So let's assume that it decides to reduce the ratio somewhat. So it issues another $1 billion. So now you have $6 billion. Okay. Now these central bank notes become reserves for the commercial banks. As they issue them, people buy things with them, and they're redeposited in the commercial banks. Which means now that commercial banks have $6 billion in reserves, well, they can expand their loans and deposits so that now the money supply is $30 billion. So we have a 20% increase in the money supply. Now what would happen? Well, prices would suddenly rise in this country, okay, by about 20% above world prices. What would happen then is that it would be very expensive to buy goods in this country, so the country wouldn't export much. Exports would fall off. On the other hand, the citizens of this country would begin to buy goods from the rest of the world. They'd increase the amount of imports that they were purchasing. So we would have a balance of payments deficit. Okay? Now, foreigners would not want to hold the central bank notes or the bank notes that were issued by the commercial banks in this country. They want gold. They want to be paid in gold. So gold would start to, let's say you had a $1 billion deficit. $1 billion would begin to drain out in gold. The people who had to make these payments abroad would turn in their bank notes and they would demand gold because they could redeem these bank notes in gold. They were promised that. Okay? All bank notes by commercial banks were redeemable in gold, dollar for dollar, as were central bank notes. So to make a long story short, there would be an external drain to finance the balance of payments deficit. And as people saw gold flowing out of the country, they begin to be frightened. So the next step would be an internal drain where people begin to say, wait a minute, I want my gold. But of course, there's $30 billion outstanding. There's only $1 billion left in gold. Central bank wouldn't let it get that far. When they saw that, they would raise the interest rate, which would mean that banks would borrow less from the central bank, and in fact would begin to pay the central bank back, and they would destroy some of the notes that they had created, which would bring the price level down, and the gold flow would reverse itself. In fact, they may actually deflate the money supply below 25 billion, so prices fall below the world level, so that they can get some of that gold back. Okay, so there wasn't much inflation as a result of what's called the price specie flow mechanism. And by the way, that's what keeps the money supplies distributed between the states and the United States. Okay, we don't collect statistics on it, but if prices tend to rise in one state above other states, money will flow out of that state. Okay, but we don't hear about it. Okay, no one state can create money and keep that deficit going, right? As governments can. Okay, and thirdly, the third point I wanted to mention is that because there were these golden handcuffs on the central banks, business cycles were few and far between. Okay, they tended to be localized. Okay, certain banks would expand here. This wasn't a legal ratio. Usually they could set their own ratios. If they became imprudent and a few banks began to inflate, they would cause a localized inflation. There would be a loss of gold. There would be a boom and a bust, and you would have bank runs, and some banks would fail, and you would have a collapse and a recession. But they didn't tend to last long. Banks realized pretty quickly that if they overexpanded and caused inflation, they would pay the price. Okay, so that would, Mises points out that would last about a generation. 20 years later, they'd start doing the same thing again. Okay. Then in 1931 in Great Britain went off the gold standard. Well, actually, let me step back. All countries went off the gold standard in 1914. Okay? In 1914, with the outbreak of the war, within 2 weeks, every single belligerent had gone off the gold standard. They had allowed the banks to suspend the redemption clause, to refuse to pay out in gold, and the central banks themselves refused to pay in gold. Okay? The United States did not do this until it entered the war in 1917, at which point it didn't permit gold to be exported. So we come to the next system that existed from 1925 to 1931. Okay, countries tried to go back onto the gold standard after World War I, and once again after World War II, they tried to go back onto the gold standard. I'll focus on the World War II, post-World War II Bretton Woods system, it's called, because I have a lot of information on this. And in fact, some supply-siders, some conservative economists called supply-siders, Reagan advisors, and there's still many around today, most of them are journalists, they pine to go back to this, what they call this gold standard of 1946 through 1971, okay, when there was tremendous growth in the U.S. and in the rest of the world. What was the what type of system was the Bretton Woods system? Okay, which really repeated the error of an earlier system, which we'll get to. First of all, there were only one or two currencies that would be redeemable in gold. Under the Bretton Woods system, it was only the U.S. dollar. Okay, the U.S. dollar was redeemable at the price of $35 per ounce. That is, the U.S. government, U.S. Treasury pledged to pay 1 full ounce of gold to any foreign government or official institution that turned in a dollar liability. Okay, U.S. citizens were not permitted to redeem their dollars in gold. Okay, so it was a very limited redemption clause. Now, what about the currencies of all other nations? Well, the currencies of all other nations were redeemable in U.S. dollars. Okay, so U.S. dollars form the reserves for foreign currencies. And there were fixed exchange rates. Okay, the U.S. dollar and was redeemable with the British pound at the rate of around $2.80 at the start of the system, I believe. Okay, that eventually fell as Britain inflated more than the U.S. Okay, so if you had a pound, you could get $2.80. Okay, a British citizen, for example. Okay, and so there was a system of fixed exchange rates. Finally, well, the principles of operation. Now, what happened was the system became much less stable than under the classical gold standard. Okay, and let me just erase this because we've talked about classical gold standard for a moment. Okay, we had an even bigger and less stable pyramid. Okay, at the bottom we had the gold, but it was the U.S. gold stock, which was supporting all of the other monies in the world, because ultimately all of the other monies were redeemable through their foreign central banks in gold. Okay, so you had gold at the bottom. You had Fed banknotes. The Fed had to hold a certain amount of gold, a portion of gold against the notes that it issued. That's the Federal Reserve banknotes that we hold in our pockets, wallets, purses. Above that was U.S. bank deposits, commercial bank deposits, the checking account deposits. And foreign monies were all backed by U.S. bank deposits. Okay? So then we had foreign money supplies. Now, what was interesting is that in the beginning, there seemed to be no problem with this system from 1950 to 1958. The U.S., foreign governments were inflating, were running deficits to get, they thought that this was the way to get back on their feet after World War II. So there was much more inflation in foreign countries than there was in the U.S., which meant that gold didn't flow out of the U.S. In fact, gold flowed into the U.S. for a while. And the figures were as follows. Remember, the U.S. gold stock had claims on it by foreign official institutions. And the figures were the following. In about 1950, if we have U.S. gold, and we have foreign liabilities, that is the dollars that foreigners held, in 1950, there was $25 billion of gold that was held in the Treasury, or actually by the Federal Reserve Bank, and about $12 billion of foreign liabilities. Okay. So there's more than enough gold to cover all the foreign liabilities, all the dollars that were held by the foreign central banks to back up their money supplies. So the dollar was considered to be as good as gold. No one worried about accumulating dollars. Now, after 1958, the U.S. government the Federal Reserve System began to inflate at a more rapid rate than other countries. Okay, they reestablished their currencies. They stopped inflating in 1958. That is, the major European countries. They stopped inflating as quickly. So over time, as the U.S. continued to inflate at a quicker rate, and gold prices in the U.S. rose faster than gold prices in Europe, we began to run persistent balance of payments deficits. But now here is the difference between the gold, what this is called the gold exchange standard, because it's not pure gold that flows between countries. It's also foreign exchange. Okay, this was its original name under from 1925 to 1931. And it broke down. So they tried to sort of cover it. They didn't call it a gold exchange standard under the Bretton Woods system. They called it a key currency system. And the U.S. was the key currency. But anyway, what happened was as gold flowed out of the United States because of persistent deficits after 1958, by the 1960s, okay, after the Vietnam War began especially, and the U.S. government was fighting two wars, a war on poverty and a war in Vietnam, and President Johnson, to maximize his election chances, promised that we'd both have guns and butter. We're not going to cut back on defense. We're not going to cut back on spending on welfare programs. Therefore, we're going to cover it by simply printing money up, because obviously it's unpopular to raise taxes. So by 1960, we were down to $12 billion in gold at the base of this pyramid, and this was up to this was up to 50 to 60 billion. What was happening was one French economist, Jacques Rueff, a very good economist and a friend of von Mises, said that the U.S., under this system, was able to run a deficit without tears. Why? Because as the U.S. ran deficits and began to buy more from foreign countries, and they sold to foreign countries, the foreign countries didn't ask for the gold because they were willing to what? To accept the dollars. And as they accepted these dollars, as the exporters of goods to the United States took these dollars, they brought them into their foreign central banks, and their banks bought them and created money. So that we were exporting inflation to the rest of the world. In fact, that's how we paid for a great part of the war on poverty and the Vietnam War. What we did was we sent paper money abroad, and we bought real goods and services. And they accumulated this paper money, and it was multiplied their banking systems and created inflation. Now, the French got a little tired of this. Jacques Rueff, who was the advisor to Charles de Gaulle, the French premier, pressed de Gaulle to demand gold. And they began to demand gold. And that's why we began to have this fall in the gold stock. And what was very interesting also was that in Zurich and London, there were free gold markets. That is, people could buy and sell gold in Zurich and London. By the way, from 1933 until 1976, American citizens were not even allowed to own gold. It was even against the law to own a gold deposit in Canada or a foreign country if you're a U.S. citizen. All the gold was seized by law from everyone but dentists and jewelers in 1933, and it was locked away. It wasn't locked away. People think it's in Fort Knox. Almost all of it's in really. I mean, if you saw the movie, the great James Bond movie, Goldfinger, you think it's all in Fort Knox, but it's really in the New York Fed. Okay, in downtown New York. In any case, what happened was that as the U.S. inflated more and more, the foreigners used their dollars to buy gold at $35 from their banks, because they could do that from the British bank and French bank and so on, and then sell it at $38 and $40 because the gold price is rising. So in order for the U.S. to keep the gold price down to the level that corresponded to the fixed exchange rate, they had to keep pouring out gold. That's another reason why the gold was diminishing. And so in 1968, a two-tier system was formed in which central banks refused any more to sell gold to private individuals. They only would sell them among themselves. So this thing began to tip over. It was a slow-motion collapse. By 1971, we were down to $9 billion in gold. There was $80 billion in foreign outstanding liabilities. In the meantime, the Germans began to get restless. They wanted gold. They were very, very anti-inflationary. They wanted to stop this tremendous inflation that came from accepting American dollars and printing up new marks in exchange for the dollars. This is where the U.S. Blackmailed Germany, basically. It basically said, well, okay, if you want the gold, we're not going to be able to continue to provide a defense shield against the Russians to Europe. Okay, you're going to have to defend yourself. And that's why de Gaulle, by the way, built up his own nuclear force outside of NATO. Okay, because he didn't want to be subject to this U.S. blackmail. And then in 1971, the gold rush was so... despite all U.S. threats, foreign governments continued to demand gold, and the gold rush became so feverish that all gold would have disappeared from the U.S. in 2 weeks. And at that point, Nixon went back on the solemn pledge that the U.S. made in 1946 to redeem the dollar in gold, the foreign government, closed the gold window. Okay? So after 1971, the world was completely off any sort of a gold standard for the first time outside of wartime in history. Okay? And let me give you the figures, money supply figures, very interestingly. What do you think happened to the U.S. money supply as well as other foreign money supplies? Now that we had no more gold restraint, even the restraint of the possibility of losing gold to foreign governments, which acted as somewhat of a restraint, the money supply, the amount of checking account money in the U.S. was $225 billion at that point. The amount of currency that people held plus checking account money was $225 billion. That's 1971. By today, at the end of June of this year, that had risen to, let's see, $1,272 billion. Okay, about 5 times. Okay, so the money supply increased tremendously now that the U.S. Didn't have to worry about losing gold. Okay, this is let me give you this. This is M1. Now, I prefer the Austrian money supply, also sometimes called the true money supply, that Murray Rothbard and myself developed. The statistic we developed in the 1980s, and it's now calculated by Frank Shostak, who is a financial economist in Australia. And in 1971, we had $247 billion in the AMS. That includes currency, checking account deposits, and saving deposits. All types of savings deposits in banks, which you can withdraw at any time. Okay. Now that has grown by much more, to $1,858.8 billion by the end of June. Okay. That's a 650% increase. So the money supply has increased 7.5 times by that, according to that statistic. Okay. And of course, the price level went from something like 37, okay, the index, to 124 in 1992, and it's probably near 200 now. Okay. So the price level has tripled, easily maybe more than that, since 1971. And what was interesting was that economists like von Mises, there's about a few economists that kept pointing out during the 1950s that this system, the Bretton Woods system, was exactly the system that collapsed from 25 to 31. This system used the pound and the dollar at the base. So Great Britain and the U.S. inflated. There was a world inflation, and we had the collapse of the gold standard in 1931. Britain went off 1933. The U.S. went off the gold standard. These voices, I mean, if you look at the literature in the late 50s, early 60s, mainstream economists are laughing at von Mises and Jacques Rueff. And another colleague of von Mises in Geneva, the French-Polish economist Michael Heilperin, all of them kept saying, this is an unstable system. There is no constraint on the government that is producing the currency that's accepted in lieu of gold. Okay? And that the U.S. is just going to continue. The incentives are there for the U.S. to continue to inflate to the point where the system breaks down. And there are all these crazy plans trying to, most of the plans say, well, you know what it really is that there's not enough liquidity. If we could if we had a World Central Bank printing up a paper gold, and this is where the SDRs came from, okay? This was supposed to be paper gold that you would give to these foreign governments instead of having them take real gold. I mean, and they weren't stupid. I mean, it never really got off the ground. Okay, they created a bunch of it, but it didn't solve the problem. Okay, so then what happened? After Nixon closed the gold window, we moved to for a while from 71 to 73. We still had fixed exchange rates, but now there was no basis for the fixed exchange rates. No country lost any foreign exchange, so that pretty much broke down. So what we had from you don't have it here. From 19 Yeah, right here. 73 to 1980. Okay, and then from 1988 to the present is what's called dirty floating. Okay? Under dirty floating, you have various currencies being produced by different national monopoly central banks. And those currencies are produced at different rates. So different countries have different rates of inflation. And if one currency begins to fall in value very quickly, the government will step in and attempt to prop up the value of that currency. And the way they would do that would be by selling foreign exchange. They would hold reserves of dollars, reserves of other currencies, of Japanese yen, and they'd sell foreign exchange. This is what happened in Southeast Asia in the late 1990s with Mexico. They began to run out of foreign exchange to keep their exchange rate stable. Okay. The monetarists, let me just talk a little bit about what the monetarists think is the ideal system. According to the monetarists, the ideal system is freely floating exchange rates, which we had for a very short period during the Reagan administration. Here's what the monetarists said. They said, look, let every government do what they want with their money, okay? What we're interested in is preventing monetary irresponsibility, high inflation in one country from affecting the money supplies of other countries. The way to do that is to simply allow currencies to find their own natural level on the market. So if Great Britain is inflating much more than the U.S., okay, if they're increasing their money supply at, let's say, 20% a year, and the U.S. is increasing it at 5% a year, then prices in Great Britain will rise more than in the U.S., let's say by 15% more per year, which means that the pound will lose 15% of its value every year against the dollar. So what will happen is that the pound will simply fall in value. So even though British prices are higher, there will be no balance of payments problems. What will happen is simply that their currency will get cheaper to offset the higher prices. So there'll never be balance of payments problems again. And with no balance of payments problems, no one has to worry, they argued, about losing money, their money supply shrinking because money's flowing out. And therefore, they won't put on tariffs, they won't put on quotas. So freely floating exchange rates will lead to free trade. Okay? Because no one will have to ever worry about balance of payments crises again, like they did it during the 1950s and 1960s. And I didn't mention it, but the U.S. tried all these different attempts to keep imports low and exports high. Okay? And so, according to the monetarists, and to some extent they're correct, under these pseudo-gold standards, you tend to get balance of payments crises as the inflating country loses gold and foreign exchange. And they react many times by putting tariffs and keeping out foreign goods so that balance of payments deficit isn't as bad, even though in the long run that does not work, by the way. But what the monetarists forgot about, one other advantage. They said another advantage is simply that whatever the price level is, it will be the full responsibility of the national central bank. So if there was a lot of inflation, you can only blame your own national central bank. Okay? No country can export inflation to you, which means that people would then begin to point the finger at their own national banks, and the banks would become more responsible. The banks couldn't say it's not us, it's the U.S. They're creating all this new money, which is flowing into all these dollars are flowing into our coffers and expanding our money supplies. So they couldn't do that. Okay. That's the monetarist dream. What's the nightmarish reality of that system? First of all, it gives complete control to the national monopoly. There's now absolutely no controls on how much currency can be produced. And from 1971 to 2003, as I've shown you, all nations have inflated to a fare thee well. They just continue to inflate. They're not worried about losing gold, and so on. Also, remember, in democracy, there's a tremendous incentive to continue to increase your spending. That's how you get reelected. To spend and elect and elect. Okay, you spend and spend on favored constituencies, on labor unions, on the people farmers that demand subsidies, on the defense industries, and so on. But you don't want to raise taxes. So you tend to run deficits. Now, if you try to borrow to finance these deficits, you raise the interest rate in your country. And when you raise the interest rate, that puts a damper on the housing industry, on the auto industry, and so on, and brings about, on the construction industry, it brings about a recession. Okay? So governments then naturally tend to simply print money to feed these deficits. And under floating exchange rates, there's absolutely no cost to doing this, okay, except the long-run rise in prices that you get. One other thing that the monetarists had forgotten about. There is a way with floating to benefit your favored industries. For example, in the early 80s, the U.S. car industry was complaining about high exchange rates, okay? Meaning that the U.S. dollar was very expensive, which made U.S. autos even more expensive abroad, okay? And reduced the amount of sales abroad. One way to offset that governments quickly discovered was, if you increase the money supply very rapidly, the first reflection of that increase in the money supply, the first reflection of that inflation would not be in domestic prices. Domestic prices would rise later on, a year or two later. But very quickly, foreign exchange speculators, who are always attuned to what's going on and what will happen in the future, will begin unloading the dollar. They'll begin selling the dollar because they'll be fearful that its value will drop. And that will drive the value of the dollar down and make it cheaper today. And with cheaper dollars, U.S. autos will be cheaper abroad. So it gives the government a tool to benefit in a way that most people do not understand their local export industries. Okay, by a quick burst of inflation won't drive prices up right away domestically, but it will drive your currency down. Okay, so the monetarists forgot about that, and eventually, freely floating exchange rates always break down into dirty floating, which was what we had now, and that's exactly what happens. Different countries are unhappy with the way the exchange rates are. If your exchange rate is too high, that means it's very expensive for the people in your country. I'm sorry, the other way around. If your exchange rate is very low, okay, if your currency is very cheap, it means that people in your country have to pay a lot of their local currency to get, let's say, French perfume or to get German cars. In other words, imports become very, very expensive, okay, if your currency is very cheap. If your currency is very expensive, so the consumers complain when the currency is very cheap. When the currency is very expensive, your exporters complain. If it's expensive for foreigners to buy your currency, then that means the price of the products you're selling are very, very high, and your exports fall off. So there's all this wrangling over. The U.S., for example, was saying to Japan, your yen is from 81 to 84. The Japanese yen is too cheap. You're flooding our country with cheap goods, and we can't sell to you because our dollar's expensive. Okay, so there was a meeting, and from 1985 to 1987 or so, the German central bank, the Japanese central bank, the U.S. central bank got together and sold dollars. Okay, the U.S. created dollars, and these banks sold dollars to drive the price of the dollar down, make it cheaper, so that we could sell more automobiles and more other things abroad, okay? And there was some central bank cooperation. But usually it's dirty floating. Each government interfering, trying to get an advantage on other governments, okay? And that happened all during the 1930s, by the way. And it didn't work, okay? That's why people eventually tried to go back to the gold standard after World War II. Now, this system, so what we pretty much had is a system of dirty floating with governments interfering with value of currencies fluctuating, but governments interfering helter-skelter, okay? The U.S. is always calling for cooperation among central banks. Now, what does that mean? That means what the U.S. wants is for all central banks to inflate at the same rate. If you can get all central banks to inflate at the same rate, what happens? Prices all go up together, and the value of the currencies don't change. So the push now is for a centralized inflation. And academics have come up with different plans to allow the centralized inflation, which is, by the way, what Keynes wanted. The Bretton Woods system was formulated from two plans, one by John Maynard Keynes, the other by Harry Dexter White, a communist spy who worked in the State Department and an economist. They had two different systems, and this was a hybrid of their two systems. But what Keynes wanted and we got gold because the U.S. wanted gold, but Keynes wanted to have more or less a sort of a cooperative effort of the major countries to increase the money supply together, so that no one ever had to worry about exchange rates changing or losing foreign exchange. Now, what have the new Keynesians taught us? Or what are they telling us? They're coming up with all these crazy harebrained schemes to try to get, seeing that none of these things work, they want an inflation in unison. And so you come up with all these sort of bureaucratic terms. For example, one plan is a crawling target zone. Some want it with soft buffers. Some want it with hard buffers. Basically, what is a crawling target zone with soft buffers? This not surprisingly, comes from John Williamson and C. Fred Bergston, both of whom are lifelong government bureaucrats. What they want is sort of fixed exchange rates. They want the exchange rates, the soft buffers, to fluctuate within 5 to 10%, up or down. They want the 7 major governments, the G7 governments, to agree to a targeted growth of total domestic spending. In other words, they want all governments to increase spending in the economy at the same rate, which pretty much means inflating together at the same rate. So they want, let's say, maybe 5% growth in total spending for each country each year. What they basically want is that governments can deficit spend together, finance that deficit with inflation, and keep their money supplies growing at equal rates so that no one has to worry about his or the country's exchange rate changing with relation to other exchange rates. Because the one last, as I mentioned before, the one last restraint on governments inflating at quicker rates than other governments is that the value of their currency would begin to fall and imports would become very expensive. Okay, and their consumers would be up in arms. Okay, so now they would get rid of that. Ronald McKinnon, a Stanford professor, wants a gold standard, but don't get excited, without gold. That's the name of his article. He wants a gold standard without gold. That's what he wants. McKinnon says that let's fix the value of the 3 main currencies. This was right before the euro, the Deutschmark. Now it would be the euro, the yen, and the dollar. Let's fix them within a narrow band. And what we'll do is together, the 3 countries will set their short-term interest rates in unison at the same level. Okay? And they'll manipulate these short-term interest rates from daily to make sure that money supplies increase at the same rate and that there's a common wholesale price level. So you keep the price level the same in all 3 countries, okay, in terms of single currency. Okay, it doesn't matter which of the 3, since it's fixed exchange rate, you can state any 3, but it's the same. And therefore, the price levels are the same, then, well, we can, don't have to worry about the exchange rates changing. Now, a common wholesale price level doesn't mean a stable price level. It means what? You can go up by 10, 15, 20, 30% per year. You could have inflation, but as long as it's a common inflation, okay, there will be no change in the exchange rates. Okay, so governments don't, in other words, again, it's a plan for inflating together. Finally, Richard N. Cooper, a Yale professor, has come out, frankly, for a central global bank. Okay, a global central bank, he calls it, rather. What the central bank would do would be to issue, we would still have individual currencies, dollars and pounds, but there would be a reserve. The reserve would be this currency issued by the World Central Bank. What they would do would be, every year they would buy government securities to allow deficit spending. They would buy U.S. bonds, British bonds, and so on. There would be a prorated share of the new money created by this global central bank, given to each country, according to the quotas that were agreed on at the beginning of the plan, so that all countries could run deficits that allowed their money supplies to increase, and the increase in the money supplies would be proportionally the same, so that all money supplies increase the same at the same rate, and therefore we'd all have, there'll be fixed exchange rates. Okay. He doesn't call yet for a completely unified world currency, but that would probably be the very next step. Okay, as it is in Europe. Okay. And now we actually do have the euro as sort of a model for this. where you do have one currency for different countries, okay? And where you do have pretty much one inflation rate. So from this point of view, the euro is definitely a step in the wrong direction. Even though it has brought down inflation in some of the high inflation countries like Italy and France, okay? But it has raised inflation in countries like Germany.